You've seen that on the front pages of news. You've seen the clips of people queuing around the world outside retail establishments to buy gold coins, gold bars, and we've seen that both in gold as well as in silver.
I don't think there's any particular level that will mark a peak, but equally we wouldn't be doing our job if we just thought that gold will rise at a fixed rate ad infinitum.
We still have traders shouting at each other over the desk from time to time. Maybe the days of broken phones and anger have moved on, thankfully.
Precious metals have long been seen as a store of value. Gold once backed currencies, and central banks still store bullion in their vaults. In times of uncertainty, these metals often move to the center of financial markets. Right now they're doing exactly that, although not exactly in the way you might think. Gold recently hit record highs, but actually fell earlier in the week after the US and Israel took military action against Iran. Meanwhile, silver has surged and fallen again, and some investors are rethinking what a safe haven really means. In this episode, we're exploring the market for precious metals, how it works, what's driving it right now, and whether this rally is just another cycle or perhaps something bigger. To do that, I'm joined by Michael Shui, Senior Research Analyst at Deutsche Bank in Singapore, and Rob Abel, who works in our Metals Sales and Structuring team in London. I'm Michael Steen, and welcome to This is Deutsche Bank, the podcast for the news and trends shaping the world of banking and finance. Today is the 5th of March. Let's get started. Rob, Michael, welcome to the podcast. Turning to you first, Rob, can you give us just a basic overview of the global precious metals market and how it works?
Yeah, sure. So I think when we talk about the global precious metals market, we're talking really about four metals: gold, silver, platinum, and palladium. Each have their own market participants, dynamics, supply-demand factors, but also they share many similarities, not least in the price action recently, in the way they're traded, in the way we deliver, and the way that generally the systems both financially and physically work. Gold obviously is probably the oldest, or certainly the oldest market traded. It's probably the most well-known. It's also the largest of the four metals, starting as a currency. Most recently, since sort of the abolition of the gold standard and backing of currencies, it's much more focused as an investment product. People hold it as a store of wealth, a protection against inflation, and obviously recently, sadly, you see it as a hedge against political risk in the market. It has some industrial uses, jewelry, amongst others, but it's primarily treated as an investment. Silver sits in between, somewhat of an investment product, but also strong industrial demand, solar panels, for example. And then platinum and palladium, much more on the industrial side, used for catalytic converters, both in the auto industry and other broader chemical industries as well. What they all share is that they trade really in sort of three locations, if you like. There's the OTC London market, which has been dominant for 400 years. It's a very deep market. You trade the spot, the linear products, options there. You also have liquidity in New York on the futures market, and obviously we and others trade between those two. And then finally you have really the physical market, and all of those markets drive the price. The systems of physical delivery are very interlinked. And what we've seen really over the past few years is that growing much more into a bigger, deeper market that has attracted lots more participants to the space and become much more of an interesting talking point and obviously front page news in the market these days.
Absolutely. And just to unpack what you said, you talked about the OTC market, that's over the counter. Can you just explain the difference between that and the other types of trading?
Sure. So futures market is very structured. It's on exchange, your liquidity, you trade a future. It has physical settlement in precious metal space, but versus the OTC market, which is very much a bespoke one. So over the counter, it means you can tailor that very much to your client's needs. So we can trade almost any date, we can trade any size, any type of product in terms of options, whereas the futures is a very structured market. And both of those, as I say, have their own pools of liquidity, their own links into different economies, different users, but they both drive the gold price or the other precious metals prices. And then, of course, the physical market has interlinks into that as well, taking its cues from the OTC market in London and some of the newer markets such as Shanghai, Tocom in Japan that's growing as well as the physical markets in the likes of Vietnam, Turkey, India, and of course China as well. So a number of different price drivers, all very interlinked, and one of the biggest markets and deepest markets in the world. The World Gold Council recently, an industry body at the end of 2025, put the daily volume of gold traded at over 360 billion on average. That's twice as big as any other asset class out there, that being US T-bills. So yeah, for a 400-year-old market, pretty impressive that it still dominates in terms of volume and at the moment headlines as well.
Yeah, absolutely. Thanks a lot for that overview, Rob. And then, so maybe turning to Michael, and let's maybe focus on those the two big ones, gold and silver, and first of all, gold. Recently we've seen, as Rob was saying, it's been in the headlines a lot. The gold price surged above $5,000 per ounce. It's reached multiple record highs in both January and February. And it's still above that level, but it's also there's some volatility there. We saw some sort of interesting moves. Rob already mentioned that some people hedge against geopolitics with gold, but that's not always the case. So, I mean, Michael, can you talk us through what's happening in the gold market, and also why some analysts, I think including yourself, are still forecasting it could break the $6,000 per ounce mark this year?
Yep, absolutely. Thank you, Michael. So I think it's important to keep in mind kind of the overall structure that I think has been informing gold prices over the last several years, and for for eternity in some regards. So one is really that gold is priced in US dollars. And therefore, it does tend to be rather sensitive to dollar trends. We've been in favor of a dollar weaker trend that's played out over, particularly last year, quite strongly. And generally speaking, its historical role as a pillar of the monetary system means that it tends to perform better when the value proposition of the fiat dollar is seen to be deteriorating, either because of fiscal imprudence or inflation, and gold performs worse when the opposite is true. So persistent fiscal deficits in the US and the recent bout of above target inflation after the pandemic have been canonically supportive drivers for gold. But I think there are also some deeper reasons that gold has been strong for several years now, relating to the supply-demand balance. So investment demand, as measured by ETF investment, is extremely important and positively correlated to gold prices. And this came back to a positive in 2025 after 4 years of kind of neutral to small selling. We also had a doubling of central bank accumulation in 2022 from 10 to 21% of the market. And these two forces are intertwined to some extent, in the sense that the sticky demand from central banks provides confidence to public sector demand, because central banks' investment strategy tends to be rather slow moving, and its investment horizon is theoretically infinite. And then on the other side, we should think about jewelry demand and what's been happening with that. Jewelry demand is elastic to the gold price. And since 2021, jewelry demand has contracted by 1/3. So for every 3 ounces of gold that the world was buying for jewelry in 2021, that's down to 2 ounces. So put together, this higher public and private investment demand and lower jewelry demand are structurally consistent with higher gold prices.
Oh, I see. And so you mentioned the ETFs, exchange traded funds. So that's a lot of kind of retail investors deciding to get exposure to gold through these ETFs. That's been a big trend.
Exactly.
Okay.
Yes, I wouldn't say it's exclusively retail. There are likely to be institutional players as well in the ETFs, but that certainly is a natural place for retail investors to go.
Okay. And you talked about lots of the influences there on the gold price. I mean, one other element is this idea of the safe haven, that in times of trouble, historically, maybe people invested in gold. Can you talk a little bit about that? To what extent do you see that happening? And I think just in this week, we saw one example where, equities markets were down, share prices were going down, but also did the gold price fall on the war that's happening in the Middle East. Is the safe haven thing, am I looking at that too simplistically then?
Yeah, I do think it is a bit of an oversimplification. Now, if we look at, we had an average of kind of 29 crisis events that we looked at, and gold does perform positively in the average, so about 2.5%. But unfortunately, there's a huge amount of variability over gold's performance across those events. So some of them you could have had a plus 20% performance, some of that you could have had a minus 11% performance. And so what I think that is showing is that these other forces that impinge on gold don't all of a sudden stop happening when the crisis starts. They're still active. So, and particularly I'm thinking about right now the elevated gold to US dollar beta, and also the positive correlation with between gold and risk assets. And so both of those have at times negatively impacted gold, particularly in late Jan, early Feb, and then, as you said, again this week. So it's a pretty complex interplay of factors, and where the crisis premium is only one of the things that is arguably driving gold at any one particular point.
Okay, fascinating. Maybe just sticking with you, Michael, for one more minute. Let's look at silver, which has actually, I think, outpaced gold in terms of percentage gains recently anyway. It sort of was up more than 150% over the last year or so. What's going on in the silver market? Why is the dynamic changing there? Is silver the new gold, or how do you look at that?
Yeah, very good questions. Silver is so volatile that we called it the wild child in our handbook. Other people have called it the devil's metal. I don't think it's necessarily supplanting gold's role, but to put some structure around our understanding of the silver, many analysts, including ourselves, look at the gold-silver ratio and what drives underperformance versus gold and outperformance. The underperformance episodes are easier to understand because most times those are linked with US recessions and growth downside surprises. And that makes intuitive sense because silver is one step down the spectrum in terms of investment versus industrial demand. It has a bigger share of industrial demand than gold. And the outperformance episodes, however, are a bit more difficult to put your finger on. I think oftentimes they do tend to be a reaction to previous underperformance. And so what we had last year, April 2025, was silver increasingly underperforming gold, and the gold-silver ratio reaching 105 in April. It was a monthly average of 100, and it's only exceeded 100 monthly average during the pandemic in data from 1957. So that's telling you just how much silver had underperformed gold. So I think as a result of that, investors likely gained some comfort from the idea that there was limited further downside in silver relative to gold. And then to put on top of that, and not any less important, is that the supply-demand perspective, silver has had 4 years of deficits, averaging 18% of supply through 2025, which is a pretty big quantum. And we think that related to that, we saw lease rates for silver above normal for much of last year, suggesting that the tightness in silver was impacting industrial users of the metal. So I think two reasons are likely. We had substantial underperformance in silver in 2025, and we've also had consecutive years of supply-demand deficits in silver.
Okay, great. Thanks. Rob, let's switch to your perspective here. Can you talk us through who are you actually seeing doing a lot of the buying and selling of gold and silver at the moment?
Yeah, well, certainly in the case of gold, not many people selling. We've seen over the past 3-4 years really a consistent bid, as Michael talked around, from sticky money. So central banks are always the ones that grab the headlines. I think Michael mentioned how much they've been buying recently. The average over the past 3 years, double the average of the previous decade. So there's been strong support from the central bank community.
Because there was a moment where some of the central banks sold some years back, didn't they? And they sort of reversed their stance a bit.
Absolutely. Bank of England quite famously sold at the lows 20 plus years ago. But we've seen a lot of the buying coming from maybe newer central banks, in the sense of the traditional, more conservative European central banks hold fairly significant holdings of gold already, certainly as a percentage of their reserves. But we're seeing a number of central banks globally, from LATAM, Asia, as well as Eastern Europe and Africa, really adding to their reserves over the last 3 or 4 years for a lot of the factors that we've already talked about. We're also, as Michael mentioned, seeing new sticky money coming in. So asset managers, insurers, family offices. You've seen that globally in India, in China, US, as well as in Europe, that really gold has become an asset class that people are very comfortable to allocate to and hold on a long-term basis. And I think that stickiness that we've mentioned and the confidence of the central bank buying that's given to the market has really supported the idea that other asset holders can come into the market. And obviously, even only a small allocation from them into the gold market makes, as we've seen, a fairly significant impact on the market. I was going to say, we've also seen, and you touched upon it, the retail demand as well. And I think you've seen that on the front pages of news. You've seen the clips of people queuing around the world outside retail establishments to buy gold coins, gold bars. And we've seen that both in gold as well as in silver. You've also seen the likes of Walmart and Amazon starting to offer the product online. And I think, again, that's a real reflection, of course, of the new appeal and the new buying power that we see in gold and silver. And then, of course, finally, we see the fast-moving, the CTAs, hedge funds that have been active in the market as well, whether through buying physical and of course also through option products as well.
Excellent. So, London, as we've touched upon, is a major hub for trading precious metals. But, we're a global bank. We're sitting in 3 different locations, Singapore, London and Frankfurt today. Can you talk a bit about the differentiation in how these trades happen across the world and the different locations?
Yeah, absolutely. So Deutsche Bank, we're active in 15 countries around the world on a physical basis, as well as I talked about the various exchanges globally that we talked about. And we do very much see the difference between, in the physical market anyway, on seasonality, on religious festivals. So we had Diwali, that's obviously a very popular period for people buying jewelry, as Michael talked about. We've seen Chinese New Year most recently. You see demand from that increasing as well. But actually the trend is fairly consistent, as I talked about, in the sense of the appetite for buying gold and to a certain extent silver as an alternative to gold. But the physical demand has been very strong. We see that in the turnover in both on physical markets itself, as reported by industry bodies, but also the increased turnover on some of the local exchanges, again, reflecting that demand for gold and silver globally.
Okay, Rob, it's been clear that there's been a lot of volatility in prices recently. What options are available to clients in that kind of environment?
Yeah, so one of the great things about the precious market is that it trades in a very similar way to foreign exchange. So there's a gold yield curve, for example, a gold interest rate, as there is a euro or a dollar interest rate. What that means is many of the products that have been popularized in the FX space are therefore easily transplantable over to the gold market. So from vanilla options and collars that we transact with our corporate clients that want to either protect their price from depreciating, or in the case of consumers, appreciating. So a simple vanilla option where they pay the premium to protect themselves to upside moves, to collars where maybe that price participation is banded, all the way through to some of the more exotic options, again, that's popular in the FX space, that center around vol knockouts, vol var swaps, which are very much the sort of exotic, most structured end of the FX spectrum. So we have a whole wide range of products that really enable both our corporate clients, but also investor clients to really either protect themselves for price moves or find the right expression of their view for the market, whether that be on a linear basis or on a vol basis. Very much linked to that as well is our offering from our Autobahn platform, as well as our multi-dealer platforms that really enable our clients to leverage the OTC nature, the over-the-counter and bespoke nature of the precious metal market, and really get the right expression of their views.
Okay. Well, it feels like we could do a whole episode just on all those various technical options and derivatives, but we won't. Instead, I just wanted to ask it a little bit, and I think be interesting to hear from you, Rob, on this, because you've been involved in this market for 20 odd years or so, is how it's changed over the years. I mean, we've already said this is one of the oldest markets out there, but of course, we've come a long way from traders, I guess. Shouting at each other down a phone or meeting in an actual marketplace. Can you talk us through how the actual trading happens these days?
Yeah, absolutely. And it's interesting you talked about traders meeting up. It wasn't that long ago, maybe only just over 20 plus years, that the gold market used to meet twice a day in person to set the official prices. They'd sit in a room with little flags to say when they agreed to the price. So you're absolutely right. The market has evolved and moved on a great deal in a relatively short space of time. A lot of it is, of course, electronically traded now. That enables us to offer both liquidity to our prices, automation, straight through processing, and also pre and post trade services that are very much valued. And again, much of that comes over from some of the other markets like foreign exchange. What's interesting, I think, is that the market, although 400 plus years old, continues to get deeper, continues to innovate on how we do that. Though I would say that we still have traders shouting each other over the desk from time to time. Maybe the days of broken phones and anger have moved on, thankfully. But I think one of the great parts of the metals market being physical is the clients value that face-to-face meetings, those face-to-face conversations or phone calls, around the market. So although we've leveraged many of the electronic offerings that the other markets such as FX have, the physical nature of the market, I think, still adds something to it.
Okay, excellent. Thanks for that. Let's turn back to Michael in Singapore and do a bit of crystal ball gazing and ask, how do you see things developing from here? There's obviously a discussion on how far this kind of big rally can go. Is there a point where investors say, well, no, I'm done here? Or is this part of a bigger, longer term trend where precious metals just keep on getting more and more valuable? Some people would argue, well, what's the actual intrinsic value here? We've heard, of course, both silver and gold clearly, and the other precious metals do have some industrial value. So there is that. But how much is this speculation? What are your thoughts, Michael?
Yeah, I don't think there's any particular level that will mark a peak, but equally, we wouldn't be doing our job if we just thought that gold will rise at a fixed rate ad infinitum. So our framework would suggest that there are several ways of thinking about the downside risks. One, what is the risk of a more extensive downturn in the equity market as a result of AI adoption or higher energy prices? Gold has been positively correlated to equities for 6 of the last 7 years, and it's the highest correlation this year. Second, are investors seeing the likelihood of a new dollar appreciation cycle, potentially related to a more hawkish Fed under Kevin Warsh? Or potentially could there be a drive to a more balanced federal budget? I guess that last one we can pretty much cross out. But more balanced budgets and even surpluses were related to gold weakness in the 1990s. On third score, is there a worry that central bank demand from the EM central banks could slow? Potentially if they were to reach a certain share of gold in their FX reserves, would they slow their purchases? And then fourth, is there kind of a memory effect to gold's fair value such that years of outperformance should then be followed by years of underperformance? I think on most of those scores, we don't think that that is the case. While there may be episodes of equity weakness or dollar appreciation, we don't see that becoming yet a secular trend. And we certainly don't see EM central banks slowing their purchases just quite yet. But those are important things to keep an eye on. And as far as kind of intrinsic value and speculative activity, I completely agree. It is difficult to pin your hat exactly on intrinsic value for gold. And also, it's absolutely true that there has been a large contribution from speculative investors, as we said, through ETFs, and other such products. So those are certainly things to keep an eye on, but they're also have tended to be a structural feature of gold. It's just investment demand is what gold is really made of in a way. So I wouldn't say that should be necessarily a concern for leveling out or weakening of gold. But as we see it at the moment, all of these factors are still arguing for some further strength in gold. So we are looking for a $6,000 level this year. And just to note, although that does, it's a new nominal high, it wouldn't be quite as extreme as gold's outperformance versus the dollar performance as we've had in the last 2 years. And so it would be, it's not, we don't see that as unachievable whatsoever.
Okay. Well, look, thank you both for sharing your deep insights and experience on these markets. Before we let you both go, there is the final question we ask all the guests on This is Deutsche Bank, which is, can you tell us one thing that you're dedicated to in your daily lives? And Michael, when I turn to you first.
Yep, sure. So, as you might know, I've relocated to Singapore in just the last year. And one thing that I've been dedicated to is keeping up my physical fitness every day, or at least most days each week. I do think it helps you to keep mentally sharp as well. So that's important to me.
Excellent. And Rob, how about you?
I'll continue with the sporting theme. I run some junior sports teams outside of work, and that's a great contrast to the day job. So far, they haven't asked me about the precious metals market. Maybe there'll be a sign if they do when 11-year-olds and 12-year-olds ask about it. But actually, I'd say also from a work perspective, metals goes through cycles, and there's certainly been periods in my career where it's really not been flavor of the month. It maybe hasn't even made a footnote on a monthly or quarterly management report. So the metals market being front and center at the moment makes every day really exciting, and long may that continue as well.
Great. Thank you both very much. And thank you for tuning into This is Deutsche Bank. If you enjoyed this episode, please do subscribe or leave us a comment and let us know what you'd like us to cover in any future ones. We'll be back soon. In the meantime, take care und bis bald.
This podcast has been produced by Deutsche Bank and may contain research as defined in MiFID II. The information discussed is believed to be reliable and has been obtained from public sources believed to be reliable, although Deutsche Bank makes no representation as to its accuracy or completeness. Opinions, estimates, and projections discussed constitute the current judgment of the speaker at the time of recording. They do not necessarily reflect the opinions of Deutsche Bank and are subject to change without notice. For further important information, please visit research.db.com.